The cost of capital is the weighted average of the required returns of the assets or securities that are used to finance the company. This is known as the company's weighted average cost of capital, or better known as WACC. Most companies raise capital with a combination of debt, equity, and hybrid securities. The mix of financing sources, and the required rates of return of the company's lenders and investors are incorporated in WACC. WACC is affected by risk. That is, the required rate of return on assets or securities will be higher if the company is riskier. The riskiness of the company affects the proportion of debt and equity used for financing. WACC is useful in a number of ways. WACC is used to value the company. WACC is used as a starting point for determining the discount rate for investments the company might undertake. WACC is the appropriate rate to use when evaluating performance, specifically whether or not the company has created value for its shareholders. A company that uses debt, preferred stock and common stock to finance itself would have a WACC like this. WACC is basically the sum of the weighted after-tax cost of debt, weighted cost of preferred stock, and weighted cost of common stock. Let's dive deeper into the WACC formula. WD is the weight of the company's debt. KD1 minus T is the cost of debt after tax. It is essentially the required rate of return of the company's debt. WPS is the weight of preferred stock. KAPS is the cost of preferred equity capital. It is the required rate of return of the preferred stockholders. WCS is the weight of common stock. KCS is the cost of common equity capital. It is the required rate of return of the common stockholders. WACC can be estimated using the following 3 steps. First, find out the weight of each source of capital, and lay out the company's capital structure. Second, estimate the cost of each source of financing. Use the current market value of each source of capital. Note that this must be based on the current costs, not historical. Third, calculate a weighted average of the costs of each source of financing. Let's look at how the weights of companies' capital structure is determined. The weights are based on the following sources of capital. Debt can be short-term and or long-term. And equity, preferred and or common stocks. Liabilities such as accounts payable and accrued expenses should not be part of the capital structure. Ideally, the weights should be based on observed market values. However, not all market values are readily available. As a result, book values for debt and market values for equity may be sufficient. Let's go through an example. ABC Inc. is financed by $100 million of debt, $50 million of preferred equity, and $150 million common equity. If the company were to borrow the same amount of money today, it would have to pay lenders 8%. Preferred stockholders currently demand a 10% rate of return, and common stockholders demand 15%. Assume that the company's marginal tax rate is 30%. The total capital adds up to $300 million. Let's calculate the weights for each source of capital. The weight for debt is equal to $100 million divided by $300 million, which is 1/3. The weight for preferred equity capital is equal to $50 million divided by $300 million, which is 1/6. The weight for common equity capital is equal to $150 million divided by $300 million, which is 1/2. Let's calculate the WACC. The after-tax cost of debt equals the weight of debt, 1/3, times the after-tax cost of debt, 8% times 1 minus 30%. The after-tax cost of debt equals 0.0187. The cost of preferred equity equals the weight of preferred equity, 1/6, times the cost of preferred equity, 10%. This adds up to 0.0167. The cost of common equity equals the weight of common equity, 1/2, times the cost of common equity, 15%. This adds up to 0.075. The WACC is equals to the sum of 0.0187, 0.0167 and 0.075, which is approximately 11%. Thank you for watching.